Investing 10K into FEPI, the Rex Fang and Innovation Equity Premium Income ETF. This one has surprised me significantly. We're going to talk all about this one. I have not mentioned it on the channel before, but a lot of people have commented it, and I do think it's definitely worth a video. I was surprised by what I found. A lot of the times when I see stuff that I don't love in ETFs, I'll talk about it, but this one, I have not seen a lot of downsides so far. But again, I haven't researched it too thoroughly. Now, what we're going to do, we're going to look at the price appreciation. We're going to look at the website. I think those are really, really key when we're looking at what we're going to be buying. The distribution history, again, another key factor. Then we'll put it in the drip calculator. I already ran the numbers, and it is pretty impressive. I'm not going to lie to you. And then lastly, our 10K investment to see how much money you'd make. Now, if you know from either the caption or the thumbnail, this thing is currently yielding about a 25% return, which is phenomenal, especially when you look at the fact that it's only down 2.5% the last year. So I'm really, really impressed by what this company is doing. There is a ton of potential here, and if they can continue in this trend, it would be a phenomenal one to buy and hold for the long term. But before we get into all of the details, don't forget to like the video and subscribe if you are interested in this content. I am doing some streaming over on a new website called stonks.com. It's over on my channel if you are interested in checking that out. Just doing some live streams. We do dividend research, all sorts of stuff. And so if you're interested, check that out. And as always, I'm super grateful for you guys watching the video. Let's go ahead and jump right into the data. From the website, I pulled up FEPI's fact sheet. I love looking at this information, getting more familiar with it, and I recommend everybody do it. Now, this one, it surprised me in a number of ways. The first, the distribution rate of 25.2% is even better than some of the YieldMax funds, and this one is not suffering from the NAV erosion like we have seen. And there's a few key factors for this. Number one is how they do things. So they own big tech. They own a lot of different large tech companies, and that is actually, they own the 15 stocks from the Selective Fang Innovation Index. So they already own these companies, and then they write covered call options on them, which they are able to harness some of the volatility. And depending on how good they are at writing these covered calls, you can have some great income every single month. And so that's what the income potential, that's what they're trying to do, is to provide the monthly income from the distributions to investors with no K1 form, which is important. For those of you that don't know what a K1 form is, I believe it's primarily for limited partnerships. I own a limited partnership, and basically it's another step with your taxes. If you use TurboTax like I do, you end up paying extra for this step. It's nothing significant. I think it cost me like $50. So it's not crazy, but if you have a lot of these, it could be a big deal. And so that just kind of avoids that, which is phenomenal. And so they really do benefit from big tech. For those of you, I mean, as a younger investor myself, I'm about to turn 27. I think it's really, really important to invest at your risk level. Now, this is not financial advice by any means, but we are younger. We have more time to fix mistakes that we make. If we make some bad investments or whatnot, we'll have time to invest in the lower yielding 4 to 5% yielding stocks in the future, or just the larger indices at 8 to 10%. Right now, we can go a little bit riskier. We're investing with less money. Our losses will be percentage-wise much less than when 20 years down the line when we're investing with hopefully millions of dollars. But what I like about this is it provides exposure to these big tech companies that I think are going to continue to boom. We've seen them booming over the last probably a decade, and I don't think that they're going to slow down anytime soon. There may be some pullbacks, but I think in the end, big tech is higher risk but higher reward. And so then we get the income generation we see in kind of the middle of the page here, where selling out of the money call options, harnessing big tech volatility while capping some of the potential stock gains is also good. So instead of, if maybe you own some of these larger big tech stocks and you just want some monthly income and a little bit of less volatility from just the price of those, then boom, you can actually own this and get some of that income every single month. So I do think it's really interesting the way they do it, the downside buffer. They use covered call approach to counterbalance potential market declines, seeking to offer mitigation from price declines on these big tech stocks. Now the 15 holdings, what is, this might not be, no, it looks like 15. Salesforce, Tesla, Palo Alto Networks, Adobe Systems, Amazon. I own Amazon and I own Tesla. So a little bit of a downside if you're kind of double dipping, but again, this one is for return on investment. So I'm not looking for this one to go up 200% like Tesla did or like Amazon has been doing in the last couple of years. I'm looking for this one for monthly income. That's the point of the fund. Advanced AMD, Advanced Micro Devices, Google, Intel, Meta, Microsoft, Apple, Netflix, Broadcom, NVIDIA, and Micron Technology. I'm sure you're familiar with probably 90% of those, just like I am. And so they're solid ones to hold. And what's nice too is you still get some exposure to these stocks while at the same time these things have been performing extremely well, but you're also getting paid a dividend. So I think that's phenomenal. Net assets, $303 million. Not a whole lot. I would say that it's probably around the middle of the pack for what we've seen. But I love the gross expense ratio is lower at 0.65. That used to be insanely high, but now all the YieldMax are at 0.99. So you're looking at a 30% discount on owning this one versus owning a YieldMax fund. And to be honest, a lot of the YieldMax funds have not returned as well as this one has. So just market price, 1 month, it is up 2.5%. Year to date, down 1.14%. But since inception, it is up 5.86%. So still definitely something to watch. And looks like the underlying index has been performing extremely well too, which I'm not surprised about. And I doubt that they are including dividends in this. They might be. This is probably just the price action. Maybe not. It all depends. So there's not a whole lot of information down here. It's all about the high risk and whatnot. If you want to read through that, I recommend you do it. But I think I've hit all the points I want to talk about. Let's jump into that dividend history. Looking at Seeking Alpha for the dividend history, we can see they have paid out 9 dividends so far, or distributions. So they're pretty consistent. I mean, they're always a little bit over $1. They have not once fallen below that. They've gotten close at $1.08, $1.09, and a high of what, 120 almost. So very consistent dividend spread, which I like to see. No special dividends so far, but that is okay. Not a lot of dividend growth because, again, this is a relatively new fund. But I am really surprised to see this. The annual payout, $10.39 for $50 per share, is pretty insane. And this is only counting for 9 of these months. So you're really looking at roughly $13 to $14 paid out per $50 a share owned, which is great. In my opinion, that's pretty phenomenal. So the dividend is solid so far. I love that it's monthly. I love that it's consistent. And this might be one of the better funds that I've looked at on the channel. I don't own this one yet, and I honestly wasn't looking to buy more funds. I have so many ETFs, but I keep finding ones that I love. And so I'm going to be watching this one really closely. And I was looking at a couple other ones like Clippy or Clip, something or other, and the return was terrible. I may do a video on it just to point it out. But this one, I mean, when you have a solid price action, or at least on a decreasing price action over time, on top of that with this insanely high distribution yield, I mean, I think there's some really good potential here. Even with this market pulling back a little bit, they haven't dropped 10 or 15% like a lot of these other funds have. Plus the dividend is still being paid out. So we should be getting the next dividend here pretty soon, probably within the next couple of days. So I would be watching really closely. Let me know if you guys are interested in this one. I keep stuttering, but I'm just kind of surprised. So let's jump into the drip calculator and see how this thing has performed. On dividendchannel.com, using their drip calculator, we're going to invest $10,000 into FEPI versus CLIP. CLIP is the other one. It's another ETF that people have been raving about. It's got like a 50% distribution yield, but let's take a look at the performance of these two. So this is why I didn't do a video on CLIP, and I probably won't, because the returns so far, I mean, the disparity between these two is insane. With dividends reinvested, the total return on FEPI is almost 18%, about 17.5%, and CLIP is down almost a whole percent. That's with dividends reinvested. With dividends not reinvested, FEPI is actually, let's see, total return 17.18%, a little bit lower, and CLIP is a little bit better just because the price has been falling. So all in all, FEPI has been really performing well. You're looking at it's been trading since, what is that, October of 2023. So we're not even a year in yet, and we're annualized gain of about 20%. So 20% a year is phenomenal. That is absolutely phenomenal. And if you compound that over a 5, 10, 15 year span, that is insane. So what we'll do now, we'll punch these numbers into the investment calculator and see what $10,000 would get you. And for the first time, I think after reviewing an ETF that has this high of a yield, these numbers could actually be accurate. So let's go ahead and jump into that calculation and see how true this is. So as always, the disclaimer, with Dividend.com's reinvestment calculator. This is not me saying it's going to do this. This is just calculating the return rate based off what they have it as right now, based off the yield. This negates price appreciation, all right? And normally I would say that that is a benefit to a lot of these stocks, since a lot of the YieldMax funds and a lot of other high-yielding ETFs go down. It might not actually be a benefit for this fund because they did have some pretty good price return until this most recent dip. So it's actually probably more accurate than it would be for one that the NAV is eroding constantly. But let's go ahead and look at this $10,000 invested. After 1 year, this one's always easy. With 25%, you're looking at roughly 1/4 of your initial investment every single year in dividends, which is about $2,500, which that is phenomenal. You know, a 25% return is amazing. If we go to 5 years, we'll begin to see the compounding effect really be taken into effect, I should say. Basically $6,200 a year in dividends after the 5-year point. So at 4 years, with the compounding effect, you're now making half of your initial investment every single year just in dividends alone. At the end of year 5, your benefit is now $20,000. At the end of year 3, you're just under your initial investment of $10,000 at $9,600. So important to note, this thing, like I said, it has a lot of potential based off the past. The future, we don't know what the future holds, but still, by year 10, you are now making $20,000 a year off your $10,000 investment. Now, 10 years is a long time, and $10,000 is a lot of money to invest, but that return is hard to beat. We have not seen the S&P 500 on average return this much, so it is performing well. Again, we don't know how it's going to continue to perform. Let's jump it up to 15 years and see what this gets us. You are now making, wow, $58,595 every year just off the dividends, and your total return is $281,000. Insane. We'll keep going. There's no point in slowing down now. At year 20, you are now making, oh man, $180,000 a year off a $10,000 investment, and your total return is upwards of $885,000, which is hard to even fathom. But let's do the fun one. We're going to do 30 years. We're going to skip 25, go right to 30. And I always like putting this little scenario in people's heads. Let's say you are 25 right now and you're planning on retiring at 65. So you put 10K into FEPI and you hold it for 30 years and let it compound. Your total return, you're now getting from FEPI every single year $1.7 million, well over the average American salary, which is insane. And that's yearly. Your total return by this point is $8.5 million. And if you continue to let this pay out, and let's say you pull out, I don't know, $700,000 a year to live off of. Let's say you live a baller lifestyle. You're still reinvesting $1 million a year, and it's still going to continue to go up at an insane rate. We can see how quickly it jumps. You know, up here, we were only making $870,000, only. That's petty cash. And in just a 4-year span, you are now making double that. So it really is amazing, the power of compounding. I hope you guys enjoyed this video. Don't forget to like and subscribe if you do, so you don't miss out on more. Let me know what you think about FEPI down in the comments, and I'll see you guys in the next video. Thank you so much for watching.